Hello, welcome to this video. In this video, we will gonna learn together about Chapter 10, Advanced Accounting, entitled Subsidiary Preferred Stock, Consolidated EPS, and Consolidated Income Taxation. So as you can see, this chapter consists of three things, right? But I decided to only focusing on subsidiary preferred stock in this video because the consolidated EPS and the consolidated income taxation are really involving many complex computational things. So, okay, let's start to explaining in detail and learn together about the subsidiary preferred stock. Why we need to learn about this? Actually, starting from chapter 1 until chapter 9, I mean the previous chapter that you have learned, actually have this same assumption that the subsidiary company, which is acquired by the parent company, is only have one type of stock, which is the common stock. As we know together, the stock itself divided into two types. The first one is the preferred stock and the second one is the common stock. So chapter 1 until chapter 9 did not talk about the situation where the subsidiary company also has the preferred stock. So maybe you little bit forget about the difference between common stock and preferred stock. So I suggest you guys to watch the video, which I already sent the link also, about the difference between preferred stock and common stock. Okay, so the video is this. Please watch these two videos. The first one is from Invisopedia, which the video is really brief, but also clearly in explaining the difference between preferred stock versus common stock. And then the second video is this video, which talking about the types of preferred stock itself. Because later on the book, BIMS will have an example that mention about the type of the preferred stock itself. So it will be better if you understand and got the review by yourself to studying about the type of preferred stock itself. Okay, so I will go back to the book. Okay, so the subsidiary preferred stock in this book is divided into two sub-discussion. The first one is this: the subsidiary with preferred stock not held by the parent. So it means that the subsidiary company has the preferred stock, but this preferred stock are not acquired by the parent company. Not acquired. So it means that the preferred stock itself is owned by the other parties. We call it NCI, right? The non-controlling interest. And then the second sub-discussion is related with how, okay, I skip it. Okay, the second situation is this: where the subsidiary preferred stock acquired by the parent company. Okay. So in this video, in order to make you guys are not too confused with this chapter, I only focus on this sub-discussion, where the subsidiary with preferred stock not held by the parent. If you guys have understanding this one, I'm sure that it will get easier to you in understanding this one. So let's jump right into this example. Okay. when the preferred stock not held by the parent, so it's mean that the preferred stock of the subsidiary company are owned by the NCI or the minority parties of the subsidiary company. So take a look at this example. Assume that P purchases 90% of S. So P purchase S 90% for this number in cash. And at that time, when P purchases S, as stockholders' equity position are like this. And take a look at the first row. The first row is the information of the preferred stock that not held by the parent, which is in $100,000. Okay, and then this is information about common stock, PEC, and retained earnings. So the total of the stockholders' equity is $500,000. So the first issue that you need to calculate is the stockholders' equity, how much allocated to the preferred stockholders. And then the second one is how much allocated for the common stockholders. So the rule of thumb, I want to give you the information that if the preferred stock has a call or redemption price, we use this amount in allocating investees' equity to the preferred stockholders. So because of, in this example, the preferred stock has the type of a callable, so we use this number as a basic amount in allocating how much the total of stockholders' equity that remain for, that for the preferred stockholders, and then the remaining is for the common stockholders. So take a look at this part. The total stockholders' equity is 500,000. And then we minus that number with the preferred stockholders, which we get it from 1,000 shares times with this number, because it's callable amount, so we use this callable price. And then maybe you're wondering, how do we know that the preferred stock is 1,000 shares? So we get the information from this. This is the total in 1,000, right? So it's mean that this is 100,000. And then the par amount of the preferred stock is 100. So this number, 100,000 divided with the $100 is 1,000 shares. So we get the number from this. So finally, we get this number, that the total common stockholders' equity is $395,000. So we just finishing in computing the common stockholders' equity. Okay, maybe if you next get the problem where the preferred stock doesn't have the type of callable price, so you just use this number, the par amount, but because this preferred stock is callable, the type is callable, so we use the callable price and to becoming the basic number in allocating the preferred stockholders' equity. And then maybe the next is we have to calculate that in this activity when P purchase as emerge a goodwill. So the goodwill is getting from, as you have learned in the earlier chapter how to calculate the goodwill, is the difference between the implied total fair value with the book value that you've just calculated before. So this is the book value, and then the implied fair value is getting from the cash amount that P paid for purchase S, which is this, the information is on this part, and then divided with the ownership percentage, 90%. So we got number, And then this number minus this number is 45. Okay, so that's the goodwill amount. And then maybe on the next part, we get the information about the net income and dividend of S in 2017, 1 year after the, in the year after P acquired S. S got the net income $50,000, and then information about the dividend also relying on the ascent. Okay, maybe we focus first on the calculation of the net income first. Okay, so the net income is $50,000. Yeah, I will erase this. So bear in mind that this net income must be allocated for, I will use the other color, must be allocated for the parent and for the NCI. Mostly we think that the net income, we must divide it into the parent and the NCI. But for this chapter, change this mind. The first one, we have to allocate first for the preferred stockholders. Okay. The preferred stockholders, and then the common stockholders. Because the preferred stock not held by the parent, so it means that these preferred stocks, okay, are only owned by the NCI, right? And then the common stock itself are owned by two types of parties, which is the parent and NCI. You get it? So before we calculate how much that from this amount that have to allocate to the parent company, firstly, you have to allocate this number, how much that will be paid for the preferred stockholders. So as you can see here that, where is it? Nah, this is show us the information of the price per shares that the preferred stockholders will get every time the the Sun Corporation get an income. So $10 times with 1,000 shares, which is $10,000. So this one minus with this one are allocated to the common stockholders 40,000. Okay. And then the next step, this number $40,000 we have to allocate to the parent company and the NCI. The NCI of the common stock, and this one is also of course the NCI of the parent. The preferred stock. Because P owned as only 90%, so we allocate 40,000 times with 90%. So this one, and of course for this one is 4,000, right? So that's why, as you can see here, the equity in as income is only $36,000. So that's the number. And then this is the journalizing when P purchase S. Okay. And then this is it's about dividends. Where the information about dividend? So the information about the dividends paid by the Sun Corporation is on this paragraph. Sun reported net income of $50,000 and paid dividends of $30,000. And the next step is actually we have to doing same analysis like we've done before for the net income that we allocate how much to the preferred stockholders and then how much the common stockholders. And then the same also goes by for the analysis of the dividends. The total dividends, $30,000, are divided to the preferred stockholders and then the common stockholders. And as stated here, the preferred stockholders got the 10,000 and then the common stockholders get the 20,000. So 30 minus 10,000 or 20,000, and then for the common stockholder itself, just the same like before, we have to allocate how much to the how much to the parent company, and then how much to the NCI, because we owned as only 90%, so we have to times the $20,000 with the 90%, and then we got this number. And then for the NCI, we just multiply the 10% with the $20,000 and we get the number $2,000. So that's why the journalizing of the dividends received by P is only $18,000. So get from this calculation. And then the next step, in consolidating the financial statement for 2017, the total stockholders' equity are changed. Not become this number again, but change to this number. So this number is get from 500,000 plus the net income of S minus the dividend. So this number. And then also just same like before, in order to calculate how much the stockholders' equity for the common stock, we minus this number with the preferred stockholders. We get it from this number, the callable price, times with 1,000 shares, and then this number. And then here we go at the consolidation work paper for the year ended December 31, 2017. So as you can see here, there's a number here, A, B, C, D, E. There are 5 journal entries. And we will analyze it now by one, okay? So the journal number A are related to preferred stock, strip S, and then the NCI, this number on credit, and where's also the number A? Where's again the number A? Okay, this one. So the purpose of the journalizing number A, already written by the BIMS on this paragraph. The entry I, A, reclassifies the preferred stockholders' equity as a NCI. So because the bear value of the preferred stock, which is stated on this, is $10, so it means that the preferred stock of S times with shares. I'm sorry. And then, because of the callable price is this number, okay, so exceeded the fair value total. So we debit the $5,000 excess to Sun's retained earnings. So retained earnings we debit $5,000. Okay, so this is the purpose of the elimination journal entries for number A. I mean the consolidated journal entries for number A. And then for the number B is related to the elimination of the income from S with the dividend. So as we calculate before, The income from S is this number. Okay, and then the dividend is this number. So the total increasing of the investment is S is this one minus this one. Okay, so the journal number A is like this. No, I mean the number B is income from S. We eliminate it, and then dividends for the ownership of the common stock, of course, 18, and the increase of the investment in S. Okay, that's for the number B. And then the journalizing number C, the consolidated entries for number C is related to the elimination of the beginning amount of the stockholders' position in beginning time when P acquire S, which is all of this number. Okay, so the number C, we have to eliminate the beginning balance of the return earning, and then also we have to eliminate the goodwill amount that emerged from the purchasing activity P acquire S, and then we also have to eliminate the paid-in capital as stated before, and the common stock, of course. And then also we have to eliminate the investment in S, and then we emerge the NCI. Okay, so the return earnings number, this one, and then the goodwill as we calculated before, this one, and then say 40, and then the common stockholder is 200, and then investment in S, this one, this number, and this number. So this is the total is this number, right? The implied fair value. And then this is the information about the common stock. This is information about the paid capital. And then, okay, we go to the next journal. The number D. The number D is the journalizing for eliminate, to showing to merge the NCI share, and then the NCI, which is we calculate in this part. This one and this one. Okay, so the journal number D is related. Okay, I will use the other color. The journal number D is related with this green color. Okay, so the journal number D is NCI share of the common stock, and then dividend of the common, and then the NCIC. The difference between the NCI share 4 and this one is 2 and this one 2. And then also just the same like the journalizing number A is related to the NCI of the preferred stockholder of the NCI. So okay, the NCI of the preferred stock, and then also for dividend, which is related to this number. I will use purple. This one, okay, and this one, 10,000. The number is exactly the same, so there is no journal for this one. So only NCI of preferred stock and then dividend for preferred stock, which is the number is 10,000 and 10,000. So that's it for the journalizing entries when the situation related with the subsidiaries with preferred stocks, but not held by the parent. And I will skip the discussion about the subsidiary preferred stock acquired by parent, because actually this one itself is a little bit confusing, right? So, and I'm sure that if you understanding this part, you will get easier in understanding this part. So I will skip in explaining this part. So, okay, I hope this video can help you in understanding the subsidiary with preferred stock not held by parent. Thank you.